So today's topic is Introduction to Financial Statement Modeling. Reading number 38. My first and foremost question to you is, what is financial statement modeling or financial modeling? See, we are discussing about the statement modeling, right? See, model is nothing but based upon which you would predict something for the future. Model is nothing but based upon this particular activity, what you will be performing, you will try to forecast the future of, or you will try to predict the future of the financial statement. So what are the models you will be using for predicting the or forecasting the future of the company based upon the financial statements? That means every company prepares the financial statements at the end of the year or financial reports at the end of the year. Okay, this particular reports will be based upon the present data, fine. And this report, when it is prepared, it will tell you about how the company is performing or how the business is performing. And based upon this report, you will be using certain models to predict the future of the company. That means how the future of the company is going to be, so that the potential investors will understand about the company's performance of the future, or the prediction of the company's performance, or the prediction performance of the company in the future, and they will just plan or they will just decide to invest. Okay, that is all about the financial statement modeling. So again, I repeat, financial statement modeling is nothing but it provides a numerical view about the company's performance today, and also based upon that, people can definitely decide about investing in the future in the same company whose modeling we are doing, and this model will help them to understand the company's future performance, and they can better decide whether to invest in the company or not. Fine. So that's what is all about the financial statement modeling. The financial statement, what we prepare at the end of the year, tells us about the present situation. Based upon that, we will be using certain models. The example of certain models here I can give you is ratio analysis. The models I can tell you which can help you to predict about company's future performance can be common size analysis, comparative analysis. These are the models based upon which you can definitely forecast company's future performance, and these models will help the investors to understand about the company's future, how it's going to be. Okay, or they can predict the company's future. For example, the PE ratio of a company tells us about the company's future, prospects of company's future prospects of its stock price, how the stock price is going to be in the future. Based upon that, the people and the investors can decide whether to buy the company's stocks or not. Fine. So this is what is about financial statement modeling. Now let's understand how to develop a pro forma company model. See, pro forma company model is always based upon what? Estimates. Fine. So we will see now how we are going to develop a sales based. Okay, the entire the figures what we are going to consider are going to revolve around the revenue, and then we are going to make certain estimates. Okay, and then we are going to make a pro forma company model to take certain crucial decisions. Fine. Now, a sales based pro forma company model consists of projected future financial statements. As I told you right now, the financial statement modeling is all about preparing the statements today can give you the idea about company's present performance. But if you use certain models with which you want to judge a company's performance or predict or forecast a company's future performance, then you can do that. And I have given you the names of certain models with which you can take the present information which is published, and that means the present information which is given to you in the form of financial reports or statements. You can extract data from that, and you can based upon these models, you can try to predict the company's future performance. In the same way, they are making a pro forma model right now, and they want to project the company's financial future financial statements. That's what is the agenda of using a model here. So sales based pro forma company model consists of projected future financial statements based on analyst estimates of company's future revenues. That means what is the revenue going to be in the future, seeing the past data of some years. Like I can use one more term here, trend analysis. So if you have a trend of company sales, how it was, how it has been, and how it will be in the future, seeing the trend, you can definitely forecast the company's future sales, right? So we summarize the steps in creating such a model here. So what steps they are giving you to create a model, which is very handy for you to learn as a student. In our equity investments reading on company analysis forecasting, forecasting, we will describe some of the steps in more detail. So there we have used this term forecasting. Now, how are you going to forecast a company's future performance based upon its revenue? You're going to see here. So first and foremost, what you're going to do, all these are estimates. First, you will estimate. Estimate is nothing but you're, using probabilistic model, or you are having certain estimations in your mind that your sales is going to be so and so percent in the future of the present. Let's say your sales today is 1 lakh, and seeing the market growth, you are expecting that it is going to increase by 10%. So it becomes 1,10,000. That is your estimate. So estimate revenue growth and future revenue based on market growth and market share, a trend growth rate or growth relative to GDP. So they are saying that you link your revenue. Whose revenue? The company's revenue. Okay, you link the company's revenue with market growth. If the market is growing, the revenue may grow by, if market is growing by 10%, the revenue may grow by how many percent? That you can check the trend, which you already have collected some data, and then you can estimate. Or if the market share is increasing by 20%, the revenue growth can be seen by how much percent? If there has been an increasing trend, every year the sales is increasing by certain X amount, X percentage, sorry. So in future, how the revenue growth is going to be? Okay, and or the company's trend, company's performance we can take. If the company performance is being like increasing every year, then how the revenue is going to grow? Or you can link it with the economy's GDP, a country's GDP. If the GDP is going to grow by 8, let's say India's GDP is growing by 8%. If it becomes 9%, then how the revenue is going to grow? So all this can help you for estimating your revenue growth. Then you can estimate the cost based upon the percentage of sales. That means if your COGS is 100,000, and if your sales is 400,000, so your COGS is how much? 25% of your sales, right? Example. Or on a more detailed method based on business strategy or competitive environment, estimate the selling, general and administrative expenses as either fixed. That means you can fix it, because these is a fixed cost. This is a fixed cost. Why? Because its nature is fixed. Growing with revenue, that means if your revenue is growing, the fixed cost also grows. We call them as step cost. That means this year it will be stable, but next year if the revenue is growing, you increase your fixed expenses also by some percentage. Why? Because you will accommodate more space, maybe you'll add more space, or your rentals can also increase. Your landlord can demand a higher rental from you, or using other estimation techniques. Estimating finance cost, this is also a fixed nature cost, using interest rates. The interest rates, what they were, what they are, and what they are going to be. And debt levels, that means how much company takes the debt in the total capital structure, and the effects of any large anticipated increases or decreases in capital expenditure. That means, are you going to raise more capital so that your interest has to be adjusted, or anticipated changes in the financial structure. That means how is your debt, how is your capital structure going to be? Today it is 40:60. That means 40 equity and 60 debt, or in future it can be 50 equity, 50 debt, or it can be 40 debt and 60 equity. We don't know, right, what the capital structure is going to be. We can take multiple combinations, and we can estimate our finance cost based upon our anticipation of the changes in the financial structure. You can be more flexible, like you can take more number of combinations and you can estimate. Then you can estimate the income tax expense. Of course, the companies usually do this. Provision for tax is always maintained, right? And this they usually do. And also the cash taxes, what you're going to pay using historical effective rates, effective tax rate, and the trends, segment information about the company, different segments of the company for different tax jurisdictions. In US, you know, there are a lot of states, and every state has its own unique tax, collecting mechanism. So you can see what rates are applicable in what, unlike India, whereby we have certain fixed system, but they have different rules and laws. And anticipated growth in high and low tax segments, taking into account changes in deferred tax items. So this more information can be, more you can understand this in a more proper way if we if we are going to do the accounting for income taxes topic. Then model the balance sheet items, model the balance sheet, sorry, based on items that flow from the income statement, working capital account. Model the balance sheet based on items that flow from the income statement. See, there are many items of the balance sheet which flow from the income statement. Example, inventory. Inventory happens to be a current asset which you can see also in the balance sheet of the company, but it's very closely linked to the income statement, because when you purchase the inventory, it can be a asset, but some portion of inventory, when you sell, you recognize the revenue and you also recognize the cost with respect to that. And when you sell inventory to someone on credit basis, it creates credit revenue, that is receivables. So receivables is nothing but credit sales. So the credit sales which you are showing in the income statement as a revenue figure, that credit sales figure in the balance sheet is receivable. So that's the reason why they are using the working capital accounts here. Okay, and in the same way, credit purchases, payables. So these two are linked. Credit purchases comes in the COGS, and there you show it as purchases. You don't mention the status of that as credit or cash, but you write payables in your balance sheet. Then you should model the balance sheet based on the items that flow from the income statement. Okay, and use depreciation and capital expenditures. They haven't given a model as such here, but that is not there in your syllabus also. But how you can model, they have given that information. So next point is, you can take depreciation and certain capital expenditures, certain capital expenditure which company only pays once for maintenance and for growth, to estimate capital expenditures and net property, plant and equipment for the balance sheet. That means depreciation expense can give you an idea about the asset value. Let's say your asset you are going to use for 10 years. Let's say that is an estimate you made, and the depreciation is going to be 10%, and the asset is 100,000. So per annum depreciation is going to be how much? 10,000. That tells you that every year the straight line method is used for depreciating, and if you multiply this 10,000 with 10 years, you can get the asset value, right? So then you can do this and use the completed pro forma. So you can use depreciation and certain capital expenditure to estimate the capital expenditures. That means whenever you purchase certain asset, that's a capital expenditure. And also then you can write the net property, plant and equipment amount in the balance sheet after deducting its depreciation from it. So for that, you're estimating the depreciation percentage, the number of years. Okay, and if at all there's a scrap value you're expecting, you can estimate that as well. You use the completed pro forma income statement and balance sheet to construct a pro forma cash flow statement. So these are the steps you need to follow for making a pro forma income statement based on the revenue growth and future revenue and or market growth. And also you can link the items of income statement with the balance sheet items which are closely connected with the income statement items. And then you can also at last you can find out the value of the fixed assets with help of depreciation, which again appears in the income statement by your estimations. And then you can, when you have made your income statement, pro forma income statement, that means the forecasted income statement and forecasted balance sheet based upon your estimates, you can also make your forecasted cash flow statement. Now, next question, what we are looking at it, explain how behavioral factors. See, a person's behavior matters a lot. Okay. Let's say an analyst has given his or her own forecast. Okay. Then what happens is, you being the user of the analyst's forecast, okay, may have certain kind of behavior, or you may show certain kind of behavior at times, okay, which could create certain confusion. Okay, so the question says, explain how behavioral factors, see, what analyst tells and what we infer is not always, or what we want is not always going to be the same. See, you cannot get 100% service from anyone. There are many doctors you consult, many chartered accountants, many lawyers, many teachers, many faculties, but always you may not get the 100% accurate satisfaction from anyone. See, that's a natural fact. In fact, I reciprocate the same. Even people, even all these people who give services, they do not expect 100% from their clients as well. That is, you cannot do that. So explain how behavioral factors affect analyst forecast. That means your behavior being the user of the forecasted of the forecast made by the analyst, and recommend remedial actions for analyst biases. That means maybe the analyst may at times be biased. Maybe you, when you take the analyst forecast reports, you may be biased. So these bias can create certain kinds of confusion. So what are they? See, like everyone, see, that's what they are saying. We all are human beings and we may make some blunders. So like everyone there, those in the financial industry are prone to behavioral biases. What is this behavioral bias? For analysts, these biases can result in inaccurate forecasts. So they are speaking about the analysts. They are pointing out the analysts, and they are saying analysts who forecast companies' future based upon certain models can definitely make certain blunders, or can make certain inaccurate forecast, because they may be biased. Biased is nothing but they may have some imbalanced thoughts. Okay, their thoughts may not be balanced. They may be thinking only one-sided thinking. They may have a partial thinking. Okay, a more of unbalanced approach. So first one is overconfidence bias. So being an analyst, they may be very much overconfident at times. They may not hear anyone. Okay, when that happens from certain people who are skilled in certain area. So this is having too much faith on one's own work. So what happens, let's say if I am a teacher or a faculty, okay, and I'm taking some topic. Okay, I have a research of some 15 years, okay, or 20 years. Don't you think that a person can commit mistakes sometimes? Every person in his or her life commits mistakes. No one is perfect. So maybe I have committed some mistake, maybe. Okay, and some student pointed out and said me, like, you have committed a certain mistake, Mr. Jayant, and like I'm not ready to uh, take that. Okay, I'm not willing, or I'm not ready, because I'm very much overconfident on my work. Maybe I gave some particular, some particular information based upon the data what I have collected. Okay, maybe the changes may happen. Changes may have happened, and I have not done a recent research. And that has, maybe some students said, sir, the syllabus, the CFA syllabus has changed, and there are some 2 topics added, and those topics are very new. So I just saw the content page and I told, no, those are not new topics, those are linked ones. But when we checked it really, we could see that a lot of new topics have come and those are not related to the older topics. So I was very overconfident because I usually take the books every day, but I have not properly checked. A student being more curious will check the content page at times, and there is a overconfidence bias. Now, this is having too much faith in one's work. Analysts may underestimate their forecasting errors. Yes, they are not ready to accept that they may also do some mistake. Hence, they have a narrower confidence interval for their forecast than warranted. Okay, so they have a very narrow confidence interval. That means they don't keep a much scope for people to question as they think. So for their forecast than warranted, that means they always say that what they say is right, but it's not always. Research has shown that analysts who go against the grain, that is forecasting what others are not, are more likely to suffer from overconfidence bias. So research has shown that analysts who go against the grain, that means forecasting what others are not. That means every analyst may forecast something, right? But certain times they may experiment and do some new kind of analysis. So that time they may make some blunders. Are more likely to suffer from overconfidence bias. This bias may be mitigated or minimized by sharing forecast and soliciting critics. That means what work you have done, you kind of share with people, okay, and you just try to understand, if some questions are raised, try to take it, but don't try to overcome and impose your thoughts on someone else. So analysts should evaluate their past forecast and learn from their own forecasting errors, which should lead to a widening of their confidence intervals. That means, yes, what happens is when you learn from, if you take more and more data of the past and you go deeply into that, you may understand that you would have committed certain mistakes, rectify them so that the confidence interval may become more widened. That means when the confidence interval is narrow, that means you have done lot of blunders and you are overconfident on that, not confident. But if the confidence intervals are widened, that means more data and more data has been taken, and more thorough research has been done, and now more errors have been rectified, so the confidence grows, right? So it widens the confidence interval. So you can do some scenario analysis, also one of the methods to do that, models to do the forecasting. You can put yourself or your analysis in different situations and then try to forecast your try to forecast on some data for which you want to do, and then that can help you to identify your shortcomings and reduce your overconfidence. That means thinking that you can never be wrong is not something something to which you are immune, right? You can do blunders or mistakes. Now, illusion of control bias, that means you always have an illusion in your mind, a strong belief, okay, and that is also something related to overconfidence, that you can control anything whichever comes to your way. That means when you drive car on a road, highway road, you think that you are kind of driving it on a speed of 120 or 140 and you may have a strong control any point of time. No, the machine, the car which you are driving can be the best one, it can have all the best safety features, but you cannot guarantee the control always. Why? Because suddenly something comes and then no one can guarantee what's going to happen, okay. So or no one can have 100% control during those times. So this is related to overconfidence, but refers specifically to overestimating what an analyst can control and trying to control things an analyst cannot control. That's what. So illusion of control biases, you sometimes do certain things which you can't control, and then you try to control certain things, okay, which is not controllable. First of all, driving on a higher speed is nothing but you are doing some mistake which may not be controllable, and then trying to control the uncontrollable things is what is a blunder, okay. So it is better to drive safely, drive in a proper drive, like the vehicle on its proper speed or prescribed speed by the government, and then you can have a better control. You cannot control the things which are uncontrollable when it goes out of control, but you can control when it can be in a better control, right? So you think that I can control everything when things go out of control, then you have no answer to that. So this bias is manifested in two primary ways. Seeking expert opinions. So what you can do at times, if you think that you can control everything, okay, whatever it is, you have better have a talk with an expert, and then you seek opinions. So seeking expert opinions to justify a forecast, and making a model more complex, that is by including more independent variables. Overfitted models are also not good actually, perform poorly out of sample, and can also conceal or hide assumptions that need to be updated based on new information. So illusion of control can be mitigated or minimized by focusing only on variables with known explanatory power. That means don't take everything to forecast your data. Okay, only take those things which can better explain the forecast. Okay, don't try to take certain variables which may not have a bigger impact on your model. Okay, and if you even take that, then you're overfitting your model, and then what will happen, it will create even more, like for example, if someone has to give you, okay, some grading, okay, and the grading system is out of 10, okay, so I have to give you out of 10 only, I cannot make it out of 30, and because I'm grading seeing your 10 qualities. Okay, seeing your 30 qualities and grading is like trying to overfit the things, which there may be some 20 qualities which you may have, but that is not relevant for my forecast, right? So don't overfit. Next, conservatism bias. So all these bias are nothing but behavioral aspects. Thinking like you have a different thought process. That means you, for example, you may be doing certain analysis, being more overconfident, or thinking that you can always control, but it is not like that. So this is also called anchoring, where analyst makes only small adjustments to their prior forecast when new information becomes available. Usually conservatism results in reluctance to incorporate new negative information. You always want to keep things as it is, don't want to make new changes. Okay, and like whenever new information comes, you don't want to change the old usual ways, okay, which you used to you know uh, do the analysis based upon. And this conservatism approach what you have keeps you more reluctant to new changes or to incorporate new negative information. You don't take you may at times not take certain information which can have an impact on your decision. However, it could also lead to lags in incorporating positive news. Okay, so like if you take more and more information, then the positive news you want to give can take a lot of time. So mitigating this bias requires periodic evaluation of forecasting errors and using simpler models that are easier to adjust for new or change assumptions. That means very important and relevant changes if you want to make, you can make, which are relevant, and then you can go ahead. Representativeness bias. This bias occurs due to a tendency to rely on known classifications. That's it. You don't want to. Hello.
So this conservative bias means like you have only fixed
Yeah,
uh,
you don't want to
change.
take new
Yeah.
things. Don't want to as the times are changing, you don't want to change
Okay.
old methods, old ways.
Don't want to
Okay,
update new methods.
don't
Yeah.
want to update. That's what, that is not good, right? And see, update, if you update lot of things, you may take a lot of time or consume a lot of time to do your analysis also. So take the most relevant new information which is relevant, right? If you don't, if these see, if I work with all the old, if I give you a particular, I'm teaching you accounting standards, okay, and there has been a small amendment. If I don't take that into picture, then how come I'm giving you the clear forecast? So when amendments happen, when changes happen, incorporate, take it and do, and that data is relevant for your analysis, you consider that. Certain things are changing, you have to, right? Hello.
Yes, sir.
Did you understand?
Yes, I understand.
So how come you can minimize that bias of not taking the new things?
By
That
adapt.
is you can do
Check that.
by periodic evaluation of forecasting errors, periodically checking, seeing that if new relevant things have cropped up. So if that is very important for your, forecast, taking that. Okay. Now,
Okay.
representativeness bias. This bias occurs due to a tendency to rely on known classifications. We have already like done this kind of topic, right? Some days back. Yeah.
Emotional bias is that called?
That is, yeah, a different topic. Yeah, we will cover that one also. That time this also will be covered. So the bias, this bias occurs due to a tendency to rely on known classification. That means what you know, you only believe that. Okay. May only be superficially similar to a known classification, but may be better viewed from a fresh perspective. One common form of representativeness is base rate target neglect. Sorry, where an observations membership when an observations membership, that means whether to consider that or not, is neglected in favor of situation or member specific information. Fixating on a firm's company specific factors is known as inside view, while viewing the company as a member of a particular industry is sometimes known as outside view. Analysts should consider both side inside and outside views to generate forecast. That means, see, you are kind of neglecting some most important aspects in your forecast, which you should not be doing, right? If you are doing a forecast based upon only inside view, that's not good. Based upon only outside view is not good. You have to consider both the views, correct? Yeah, hello?
Yes.
Any doubts?
No, sir.
Can you give me a best example of representativeness bias? See, sometimes what happens, you always think that what you think is right. Okay, you have a mindset sorry, you have a created mindset. That means you already created some mindset. That, a small example I'll give you, like let's say someone is walking on the street, okay, and he is wearing a suit and a tie. I can take a person here, he's wearing a suit and also a tie, okay, and he's carrying a briefcase. Okay, what do you think always? That he must be a lawyer, correct? Because there is a stereotype, in the society that whenever someone is wearing a black suit and is wearing a tie and carrying a briefcase, he may be a lawyer. Understood? That is the representativeness bias. That means someone who is always walking with a black suit, a tie and a briefcase represents all lawyers. But is it that? Tell me. He can be a different kind of a professional, right? He can be a person who is just walking with, who has a habit of like carrying some briefcase with some documents, important documents, and he wearing a suit. Correct or wrong?
Yes.
So representativeness bias occurs when we make judgments or decisions based on how people or situations match a particular prototype or stereotype. So I'll write the statement here, you'll get to understand. So representativeness bias occurs when we make judgments or decisions based on how people or situations match a particular prototype or stereotype. So I'll give you a small example. Don't take it either way. I'm not someone who has a racist feeling or something. Or see, in my childhood days, when I used to see some foreigner coming to India, like some African people, okay. Now, like when I taught many students in my life, the African students, I found them a beautiful people, very good natured people, very well mannered people, and excellent folks. But when I was child, I used to think that they are going to, cause harm to me. I always had that kind of mindset. Okay. So, like I always try to, think that whoever comes from Africa is kind of someone who is going to cause harm. So what was I was like having a representativeness bias. That means they always are harm causing people. But in reality, now I'm a grown up person. Now I'm a matured person, and I find those folks as most friendly ones. Okay. And that's what I'm saying. I'm clearly saying that I really had all those bias what I had has now vanished after like interacting with people and understanding their mindset. Now understood? So this is what you understood, right? When someone is walking on the street, he with a suit, a tie, and a briefcase, he represents lawyers. But is it like that? Are you biased or not?
Yes.
That's what.
So can you give an example using like a company, like how a representative bias occurs
Yeah,
in?
see, a company, see, Tata represents only automobiles. That's a representative bias because you have only seen its vehicles, but
Okay.
you haven't seen its other products. That can be a representativeness bias.
Okay. Okay.
See, representativeness bias means this particular element represents this. You are biased, but it is not like that always
Okay.
because you don't have proper knowledge or information. See, very clear. You can see. Maybe this particular here what you have seen is someone wearing this as a lawyer. Maybe there is some one more profession which has come in the market. They have also made people to wear a suit and a tie. So now what happens, you did not take the new information and always acting on the old information that these people represent lawyers only. Whenever someone is walking on the street with white shirt and pant, you always think that is a junior lawyer, junior advocate. Is it always the case? Other people can't wear white shirt and white pant? I'm not
They
getting an answer from your
they
side.
can
That's what.
steal.
So you have not taken the new information, or in lack of information, you always think that these people are lawyers who wear a white shirt and white pant. But is it always like that? No, not always like that. That's what. So representativeness bias occurs due to the tendency to rely on known classification. That means you have made a mindset in your mindset that this is like that. So you always try to go with that. That can be due to lack of new information. Maybe you have not taken into picture, or you don't have any fresh view about something. Sometimes new information may only be superficially similar to known classification. Okay, that's what I said. You always think that white shirt, white pant represents a lawyer with a briefcase. But new information is some new uniform has also been introduced for some professionals who have to wear white shirt, white pant, and they can carry their documents in the briefcase. Now they are also lawyers? No. So you're biased. So one common form of representation is base rate neglect, where an observation's membership is neglected in favor of situation or member specific information. Fixating on firm's company specific factors is known as inside view. That means there are certain factors which are only restricted to the internal of the company. Okay. And while viewing the company as a member of a particular industry, sometimes what do you think, this particular company belongs to this industry, and always that may not be the case. Okay, I always had a mindset Lakme is a French brand, because I thought that this particular name is a French, this particular name which has been taken is, or I had a confusion in my mind that whatever products come in the market related to cosmetics like Revlon or whatever are all coming from France. But when I did a thorough research, I got to know that Lakme is a brand which belongs to Tata. So that was a representativeness bias. I thought all the cosmetics which come and are sold in the world belongs to France, or all the cars in the world which are sold belongs to Japan. I am biased. So I now with my new information, I came to know that no, there are other companies, other belonging to other countries also sell cars. That's what. Now, see, there can be one more statement. All the lawyers are, I will not say all XYZ professionals. There are some people, right? They always try to say that all these people are thieves, and they always want to loot people. Okay, so that is again having a mindset, a representativeness bias, but it's not like that. Now, what is confirmation bias? See, confirmation bias causes an analyst to seek out, okay, data. So see, now when comes to confirmation bias, better I will give you a good example for you to understand rather than looking at this. So you just try to like understand what I'm saying. See, confirmation bias is nothing but only paying attention to information that aligns your existing beliefs. Okay, so you always try to give attention to only the belief what you have about something. Okay, for example, an analyst who has a positive view of a particular company may choose to discuss the firm with colleagues who share the same point of view. Okay, so again we will read out confirmation bias. See, that means you only want to discuss that information with people, okay, which is kind of supporting your viewpoint, not the ones which always is against your viewpoint. Are you understanding? I'll write the statement, I'll write the definition, don't worry. That is also called as anchoring. Okay, shall I write? Okay, so anchoring or confirmation bias. Okay, so it is a common human tendency actually to rely too heavily on the first piece of information offered. Okay, I'll give you a better example. Let me think a good example for this. What can be a good example? Okay, I'll make a small diagram and try to explain you. Okay. Confirmation bias. It is the tendency to seek out and prefer information that supports our pre-existing beliefs. Okay, so confirmation bias is the tendency to seek out and prefer information that supports our pre-existing beliefs. Okay, how come that can be a confirmation bias? That means someone told you, for example, that you look handsome. Okay, so you always try to prefer the information and you always try to ask people in some or other way that you are handsome or not, and you want to confirm that. Simple. Okay, okay, so it is the tendency to seek out and prefer information that supports our pre-existing beliefs. That means you see during your childhood days, or there are or like some people used to say that you're cute, or some people used to say that you are very clever, or you're wise, or you're handsome. Okay, there may be some people right in your family and your friends, and then like you always you created a belief of your own that yeah, you really look like that, and then you are trying to confirm with many people by in some or the other way that it is so or not. So then you are you're trying to confirm. So that is confirmation bias. And if someone tells you that you don't want to take that that information at all. You don't want to take any contradicting beliefs. Okay. So what we do, what happens because of confirmation bias? I'll tell you. As a result, we tend to ignore any information that contradicts those beliefs. That means you again try to fight with people when they say something, something against you which you don't want to listen. That means here it is very clear. You have a belief in your mind regarding something. You always want to listen that particular thing from the people, and you don't want to take any opposite, viewpoint. Fine. See, this is not, you're not doing intentionally. This is unintentional, but this is not good. Okay. Trying to create a, trying to create a firm belief about what people said you in the previous past and trying to always confirm that with everyone. It's not always good. So I'll make a small diagram. Let's say this is all about all evidences available. Okay. And there may be our beliefs as well. See, I'll make two. Okay, there may be our beliefs. See, let's say someone said that you're really handsome. So you created a belief of your own that you're really handsome. Okay, but always it is not like that. Some 5 people said you and you created a belief. But if you ask to some 50 people, maybe they may have a different viewpoint. So all evidences is what, which is all the evidences available, and this is only your beliefs. You only want to listen to those people only who are, kind of, supporting your belief. So this is the area which you want to hear. That's it. Did you understand now? So we
Yes.
only want the evidences we believe. That means there may be some 100 people who may give different viewpoints. Out of that, 10 people are always, like having the same belief as you have for yourself. You only want to listen to those 10 people and ignore 90. Finished. Okay. That's what. You can also do that from any being an analyst. You can do that, this kind of bias you may have. Let's say you believe that we all believe that Tata is a very good company, right? So if you ask anyone, who's roaming around the streets, that Tata is one of the best companies, you always had a belief about Tata and you are very firm with that belief. And when you ask some 10 people, they also have given the same opinion, but you have not asked that particular belief to more than 10 people. Okay, there can be a bigger universe where 90 people may exist and they may not accept the facts about Tata, what you have, or believe what you have. They may have a harsh experience. There are many people owning Tata's vehicles, and they may not find the services well. They are not satisfied with something or the other. So can you just go with your belief only? That Tata is a very good company? Is it the same universal truth? Everyone is having the same kind of belief? No. So you only want to listen good things about Tata company, and that you have framed your mind in that way, framed your mindset in that way. But in that way, you are having a confirmation bias that an analyst should not have. He should have a broader picture. That's what this particular question, this particular behavior aspects have been considered. That the analyst with a biased viewpoint cannot give you a proper picture about a company's performance. So you should have an unbiased approach towards anything. If someone is saying that this is wrong, yes, that can be wrong. Take it positively, not always trying to say that what you have said is always right. Okay. Yes. Are you people following? Next.
Yes.
Just a second. Can you give me an example of confirmation bias? Any of you, any one of you, please. I'm asking, can any one of you give me an example about confirmation bias? Prithvi, Akila, Tarun. No one is speaking out. Hello.
Yes.
Any? Do you have any example? Strange. Confirmation bias, cats and dogs. So basically many people have dogs as pet animals and cats also are pets for many people. Okay. Genuinely, when I tell you, like, like I understand that can be a biased one. Okay. But, most probably the, the good pet is dog, right? Yes. Yes.
Biased.
But yeah, bias. At times people can have a, you see, Prithvi, you can relate more to this, right?
Yes.
Cat can also be a better, a good pet, right? So you always have liking for dogs and you always want to hear good about dogs. Okay. When someone praises cat in front of you, that means you don't want to listen to them. That is what confirmation bias is. That's what. That's why I took this example to explain in a better way so that you will be, more of, keeping this in mind. Now, see, every company, okay, has to face certain problems in its journey, okay, because when a company is a going concern, they may have lot of issues to run their affairs. Issues in the sense they may, when I consider a market, they may compete with other firms, right? So what challenges a particular company can face in the market has been very well explained by Porter's five forces. Okay, so and the companies, even though they don't want, have to, at times make certain changes in their pricing of goods, and also they have to look at the cost, okay, factor. So the competitive environment that a firm operates in and how successful it is in that environment are key in determining firm's future financial results. Yes. So how a firm is operating and how successful it has been in that environment is very important to, you know, judge its future financial results. So what Porter has said, Porter's five forces are very important to consider about very important to consider to forecast a company's, companies challenges it faces in a particular industry to which it belongs, and also the competition it faces in that particular market. So what we do, companies have more pricing power when the threat of substitute products is very low. Yes. So threat of substitutes, of course, a company has whenever a company is selling a product and it has a close substitute, tea and coffee, etc. So companies have more pricing power when threat of substitutes is low. See, uh, tea and coffee are two, beverages which people like. But in place of tea, people can consume coffee. In place of coffee, people can consume tea. That's understood fact. But coffee has more pricing power because the threat of tea to it is very low, because coffee is liked by certain elite class. I always tell that. Coffee has a different flavor, and cold coffee, there are a lot of coffees available, right? Tea can definitely be a substitute to that, but it cannot match exactly the craze for coffee, isn't it so? So companies have more pricing power when threat of substitute products is low and switching costs are high. Okay. They have less pricing power when good substitutes are or may become available and when it is less costly for consumers to switch to these products. So what happens? Companies have more pricing power when threat of substitute products is low and switching cost is high. That means if suppose coffee and tea, okay, this tea doesn't have, is not a bigger threat for coffee, or let's say some energy drink we take, okay, or certain other kind of drink which is also available in the market, okay. So that is not a close substitute to coffee, okay, like Boost or something, anything you take, okay. And if anyone wants to switch from coffee to that, okay, the cost should also be very high for switching. Then what happens? People will be stuck to this, finished. Yes. So the pricing power will be high for coffee. Why? First of all, the other substitutes threat is very low to coffee. Okay. When I take Brazil into example, Brazil is a country where people don't compromise on coffee at all. They are mad about coffee. India is a different case. India people are mad about tea. Okay. The highest tea consuming country in the world is India. So in Brazil, even though there are substitutes like tea or Boost or some other drink, people will not go for them. They will only go for coffee, first of all. And other things may be costly in Brazil when compared to coffee. So people are stuck to this and these companies do well. Finished. So we will do one thing. We will try to continue this topic tomorrow. I'll finish this discussion. They have less pricing power, and when good substitutes, okay, or may become available. So where is that? Yeah, they may have less pricing power when good substitutes are, okay. Now coffee and tea. This is Brazil's case, right? India. In India, people kind of give importance to both, but the pricing power of coffee will be less. Example, see, now you don't compare coffee and tea. See, coffee is not in abundance, tea is in abundance, okay. So pricing power does not mean the price of a product. Pricing power means can the company raise the prices to whatever levels they want. They can't do it. Why? Because people, they switch to tea very easily because the switching cost is less. Finished. So, Potter's 5 forces are very clearly understood: threat of substitutes, or intensity of industry rivalry, bargaining power of suppliers, bargaining power of customers, threat of new entrants entering the market. This is not we are studying. We are studying the impact of this on pricing and cost. Okay, so this is a topic to be discussed in detail. Tomorrow we will do that, and tomorrow I'll wind up this chapter. Plus some 4 or 5 ratios of cash flow statement are also there. I hope I'll take a live session on it tomorrow and try to wind up that one. Okay. Thank you.
Thank you.
Thank you. Thank you. Thank you.